Hello, teacher. In my presentation, I will talk about two different but related topics from current financial news. First, I will focus on recent developments in European monetary policy and the banking sector, especially decisions made by the European Central Bank. And then I will move to a globalist perspective and talk about economic uncertainty worldwide and its impact on financial markets. European monetary policy and banking. Currently, the euro area is facing a difficult situation. Inflation has been decreasing, but it's still above the target level of 2%. At the same time, economic growth remains weak in many European countries. This creates a challenging environment for policymakers. European Central Bank interest rate decision. Recently, the European Central Bank decided to keep interest rates unchanged. This decision was expected by financial markets. The main goal of European Central Bank is to make sure that inflation continues to slow down. High interest rates reduce borrowing and spending, which helps control price growth. Why this matters? However, high interest rates also have negative effects. They make loans more expensive for households and business. As a result, people spend less money and companies delay investments. This slows down economic growth and increases the risk of a recession. Impact on European banks. European banks are directly affected by this situation. Due to high interest rates, demand for loans has decreased. Many households postpone buying homes, and companies are more careful with borrowing. This limits banks' lending activity. Financial markets in Europe. For financial markets, the European Central Bank's decision brings short-term stability. Investors are closely watching European Central Bank communication and waiting for signals about future interest rate cuts. Any indication of lower rates could lead to higher asset prices. Conclusion. In conclusion, the European Central Bank's interest rate policy plays a key role in the European economy. It helps control inflation, but at the same time puts pressure on banks and economic growth. Finding the right balance between price stability and recovery remains a major challenge. Now I will move to the global perspective. The world economy is currently experiencing a period of high uncertainty. This is caused by high interest rates, geopolitical tensions, and uneven economic recovery across different regions. US monetary policy. One of the most important global factors is monetary policy in the United States. The Federal Reserve has kept interest rates at a high level in order to control inflation because the US dollar plays a central role in global finance. These decisions affect the entire world. Global effects. High interest rates in the US attract global capital into dollar-dominated assets. As a result, many emerging markets experience capital outflows in weaker local currencies. This increases borrowing costs and financial pressure in these economies. Another important issue is weak global economic growth. Many countries struggle with high debt levels, low investment, and political uncertainty. Businesses often delay long-term decisions because future economic conditions remain unclear. Due to this uncertainty, global financial markets have become more volatile. Investors prefer safer assets such as government bonds or gold. Stock markets react strongly to news related to inflation, interest rates, and geopolitical developments. To conclude, both European and global developments show how closely connected financial markets are today. Decisions made by central banks strongly influence banks, investors, and economic growth. In the near future, monetary policy and global uncertainty will remain key factors shaping financial markets. Thank you for your attention.